When we invest money for our clients, we often use a variety of different tax wrappers. And of course, the main reason for that is that we can shelter money from tax and allow your money to grow faster. But of course, there are limits to how much we can put in and how much we can take out of those different tax wrappers at different stages. So people often ask me what the main differences are. And so the purpose of this video is to take you through how to think about those tax wrappers side by side so that you can see where each are useful and how, more importantly, they can work together to help you to save tax in the long term. So I'm going to take you through four main investment types you probably will have heard of. First will be pension, then ISA, then general investment account, which is a taxable investment that works a bit like a stocks and shares ISA without the tax-free wrapper. And then finally, just for comparison, I'm going to look briefly at property because most people are aware of property as an investment. So what I want you to think about really is how they interact together, looking at it in this way. So we're going to examine how money goes into the product, what happens when it's in the investment itself in terms of the tax situation, and then what happens in terms of tax on the way out of the product, either when you sell it or when you take withdrawals to fund income and that kind of thing. So if we look at the investments, we can see them on the side here, and I'm going to build up the table as we go through so you can see how they fit together. So let's start with pension. The great thing about pensions are that you can make contributions and the government gives you money back as tax-free. So bear in mind that a lot of this information is simplified, it's in summary form, there's a lot more complexity behind each of these items, but broadly speaking, for a personal contribution, for every pound you put in, you get 25 pence in tax relief, 25% uplift on day one, and if you're a high rate taxpayer or top rate taxpayer, you get even more back through your tax return. So money goes in, it attracts tax relief and grows faster as a result. And so still looking at the inbox, you've got limits around what you're allowed to pay in because the government doesn't want to have an open checkbook for contributions to pensions that attract tax relief. You can put more in, but you just don't get the tax relief on it. So broadly speaking, you've got £40,000 allowance per tax year. It is limited in certain situations where you don't have earned income, or you've started to take taxable withdrawals from investments, or you're a high earner. As I said, it's complicated, but basically money that goes in is in green on my table because you get tax relief and it then grows the pot faster. When it's in the pension itself, it's going to grow tax-free. There are some things going on in the background, but broadly speaking, money in the pension grows tax-free and again grows faster. And when you take money out, part of it is taxable and part of it is tax-free. So you probably would have heard of tax-free cash. You can take up to 25% of your fund tax-free when you retire. These days you've got a lot of flexibility around how you take that money. You can take it in slices at different stages, so it gives you a lot of freedom to take money in a tax-efficient way. But the other 75% will become taxable should you decide to take that money at some point. So you can see there's a lot of green on my pension line, and so it's a very tax-efficient way of building money for your future. So if we look at ISAs now, the ISAs work kind of in reverse to pensions, not precisely, but for the purpose of this analysis they do. So the problem with ISAs is the money's already been taxed when you put money into the ISA. So this applies to stocks and shares or bank ISAs, cash ISAs. So you've had your salary, you've paid your income tax and national insurance, and you've got some savings in the bank and you want to shelter it from tax. Well, yes, you've already paid tax, but you can use up to £20,000 ISA allowance per person per tax year. So obviously a married couple would have twice that. And then you can place that into a tax-free wrapper that goes tax-free for as long as you want to hold it within the ISA. So it works like a pension when it's in the product itself. The difference is at the other end. When you want to take money out of your ISA, there's no capital gains tax and there's no income tax. So basically, you can see on my table here, pensions are taxed on the way out, ISAs are taxed before you put the money in, and the reverse is true. So if you're thinking ahead as to when you might want to take an income, perhaps in retirement, let's say, we can start to combine these allowances, especially on the way out, to take a variety of tax-free income. So for example, if you go back to the pension, you might want to take up to your income tax personal allowance, £12,500 out of your red taxable portion of your pension, and then you can top that up with tax-free cash, and then you can top that up with your ISA. So you can see that you can start to build up quite a significant amount of tax-free income from these two different products by combining them together. Again, across, if you're a married situation, obviously you've got more allowances with more products to use. So once you've used up your allowances, you've got 40,000 for your pension and 20,000 for your ISA allowance, really then you're looking at more general investments, so like the general investment account. So this works like a stocks and shares ISA, it's just not tax-free. And I think this shows you the power of the ISA when you start to look at the tax on normal investment products that don't apply these tax-free allowances. So again, the problem with your general investment account is it's money that's already been taxed. You've paid income tax on that money, or you've had it from another source like an inheritance. And so there's no limit on what you put into a general investment account because you're going to pay tax on it. So it's not as good as an ISA, it's not as good as a pension. When the money's in the investment itself, you're going to get taxed on the income that you receive. So there's tax on dividends at a lower rate than normal income, and there's a tax on interest from different types of investments that you have in your portfolio. So you can see that dividend tax is lower than interest tax, but you do have two allowances that we can use within your general investment account to minimise the income tax that you pay to a limit, obviously. So you've got a £2,000 dividend allowance per person. So the first £2,000 of dividends will be tax-free, and then an interest allowance depending on whether you pay income tax at 20%, 40% or higher, and it starts at £1,000. So together you can get £3,000 of tax-free income within your portfolio, and of course we'll build your portfolio to allow for those allowances where possible. And of course, if you're in a married couple situation again, we will often make sure that one investment is higher than another within the couple, perhaps to take account of these allowances in different situations. Now, the problem you also have with a general investment account is that money could be taxed on the way out. So if you sell investment funds, you could pay capital gains tax on the difference between the sale price and the purchase price. So the difference between the two is a potential for capital gain, but you've got an allowance of £12,300. It goes up each tax year, and that's per person. So the idea here is that we can switch between investments within your portfolio every annual review and potentially use up some or all of your capital gains tax allowance. So eventually, when you come to take capital withdrawals, perhaps for income, you may pay a lower rate of capital gains tax in the end because we've used your annual allowances as we go. But ultimately, if you take a larger withdrawal that has been subject to a gain, you will pay capital gains tax at either 10 or 20%. So again, it's not as tax efficient as your ISA and as your pension, but when you've used your other allowances, we can start to play with allowances within your general investment account to minimise tax where we can. If we just put that alongside property for a minute, because people are often interested in buy-to-let as a way to build up a stable income in the future, we can see that while it may have many good reasons to consider, from a tax perspective, it's not as good as the others I've shown you above. So it doesn't mean you shouldn't do it. It just means you should be aware of the tax as you go. So, when you buy a property, that's usually from taxed income. You have to put a deposit down, and that's normally coming from your savings. Although, of course, you could take that money from your ISA or your pension, but I would counsel caution there because, of course, you're taking money out of tax-free investments to do that and putting them into a taxed investment. By taking that money out. So when the money's in your property, you're going to get rent, hopefully. While you have certain allowances, you can take off insurance costs, for example, from your rent to produce your profit. You're taxed on those profits against your income, so that's going to be 20, 40 or 45%. So you can start to see that income tax on property is higher than ISA and pensions, obviously, because there's no tax on those, and higher than dividends within your taxable investment, your general investment account. So it doesn't mean you shouldn't do it, but it does mean that the income is going to be taxed at higher rates than it would be elsewhere. And the other thing to really bear in mind with property is capital gains tax. Now, you've got this allowance of 12,300, but it's only available when you sell. So within your general investment account, you can use that allowance every year if you wanted to. You don't have to, of course. But with your property, it's only one investment, and of course, when you sell it, you only sell it once. You can't sell part of a property in most cases. So you're going to attract capital gains at their worst point when the property has grown to its highest value at many years in the future. So what tends to happen is you have a greater taxable capital gain in property than you would do in a general investment account, and even worse, it's taxed at higher rates, 18 or 28%. And even worse, you have to pay it sooner than you would do with an investment account. So it doesn't mean you shouldn't invest in property, but you can see it's taxed at higher rates than other investment types that we typically advise on. So I hope that's been useful. Bear in mind that this is a summary. There's a lot more detail behind all this, but it helps you to sort of see the main things to think about when considering different types of investment accounts, and typically the tax wrappers that we would use to help you to shelter money from tax.